So, when a company makes a huge purchase, like a brand new van or a massive piece of machinery, have you ever wondered what happens to it financially long after it's been paid for? Well, it starts this whole secret life on the company's books, and that story is told through an idea called depreciation. Okay, let's dive right in.
All right, so here's our game plan. We're going to follow the entire journey of a company asset. First, we'll start with a puzzle that pops up when you buy something big. Then we'll uncover the really clever solution, see a few different ways to calculate it, understand why it matters so much, and finally, see what happens at the very end of the asset's life. So let's kick things off with a simple, real-world situation that actually creates a pretty big headache for accountants.
Let me introduce you to the Orange Company. They've just dropped a cool $200,000 on this awesome new van for their business. It's a great investment, right? It's going to help them make money for years. But that very purchase creates a tricky question.
I mean, think about it. Does that entire 200 grand count as a massive loss the second they drive the van off the lot? That just doesn't feel right, does it? Because that van is going to be out there working for them for a long, long time. And if we peek at their books, we see something kind of strange. The value of the van keeps dropping every single year. It goes from $160 down to $120 and then all the way down to $80,000. But wait, they haven't sold it. So what in the world is causing this value to just disappear?
Well, the answer to that puzzle, the solution to the $200,000 van problem, is depreciation. It's the elegant accounting trick that makes it all make sense.
Now, the most important word in that whole definition is allocation. Depreciation isn't really about the van physically wearing out or falling apart. It's an accounting method. It's a way of taking that big initial price tag and spreading it out over all the years the company expects to actually use the thing. And this is the core idea behind it all. It's called the matching concept. It's actually pretty simple. The van helps the company earn revenue for, let's say, 3 years. So it only makes sense to match a piece of that van's cost to the revenue it helps bring in during each of those years. You're just lining up the expense with the benefit it creates.
And this is exactly why we make a distinction between two types of spending. Buying the van? That's a capital expenditure. It gives you benefits for a long time, so we depreciate it. But paying for gas to fill it up, that's a revenue expenditure. It's a day-to-day cost, and the benefit is used up right away, so you expense it immediately.
Okay, so we get what it is and why it's done. But how do companies actually sit down and calculate this thing? Well, as it turns out, there are 3 popular ways to do it.
But first, a super quick vocabulary lesson so the math makes sense. Useful life is just how long they think they'll use the asset. Residual value is what they guess they can sell it for at the very end, and net book value is simply what it's worth on the books right now. Got it? Great, let's go.
First up is the straight line method. It's the most common one because it's the easiest. You just take the cost, subtract what you think you'll sell it for, and divide that number evenly over its useful life. That's it. The result is a nice, predictable, steady expense every single year. Super smooth.
Method number 2 is called the reducing balance method. Now, this one is front-loaded. The idea here is that an asset is way more useful and loses value faster when it's brand new. So you apply a fixed percentage to the remaining value each year, which means you get a much bigger expense in the early years. This is great for things like computers, and it can also help reduce your tax bill early on. And finally, there's the usage-based method. This one, you could argue, is the most logical, especially for something like a factory machine. Instead of being based on time, depreciation is tied directly to how much work the asset does. If it makes a ton of widgets one year, the expense is high. If it barely runs the next, the expense is low. The cost perfectly matches the output.
And when you see them all laid out like this, side by side, it's so clear, isn't it? Each method tells a totally different story. Straight line is that flat, steady line. Reducing balance is the steep drop-off. And usage-based, well, it can bounce all over the place, perfectly mirroring the asset's busy and slow periods. The choice really matters.
So companies get to choose which story to tell. But why should we, on the outside, care? Because this isn't just some abstract accounting game. It has a real, direct impact on a company's financial reports and how the whole world sees them. And here it is, the key takeaway. Depreciation is an expense, just like paying salaries or rent. But here's the wild part. It's a non-cash expense. No actual money leaves the company's bank account. But every single dollar of depreciation reduces a company's reported profit, which in turn reduces its taxes.
So if you ever pull up a company's income statement, you'll find it. You'll see depreciation listed right there with all the other expenses, literally subtracting from the revenue and lowering that big final profit number that everyone focuses on.
Then, if you flip over to what's called the Statement of Financial Position or balance sheet, you see the other side of the coin. The total depreciation that's been charged over the years, we call that accumulated depreciation, gets subtracted from the asset's original price. And what's left is its current net book value, just like we saw with the Orange Company's van. And that brings us to the end of the road. What happens when the company is finally done with the asset? When they sell it, trade it in, or just send it to the scrapyard? Well, in accounting, that's called disposal.
The bookkeeping is basically a three-step cleanup job. First, you take the asset's original cost off the books. Bye-bye, $200,000. Second, you remove all the depreciation you've built up against it. And third, you record any cash you got for selling it.
And that leads to the grand finale. You compare the cash you got with the asset's final net book value. If you got more cash than what it was worth on the books, hey, that's a gain. If you got less, that's a loss. It's the very last sentence in the asset's long financial story.
Which leaves us with a really interesting final thought. Remember, things like useful life and even which method to use, they're all just estimates. They're strategic choices a company makes. So this isn't about finding one single factual truth. It's about how a company decides to tell its own story and how those choices can dramatically change how profitable and how valuable it appears to the rest of the world. Something to chew on the next time you're looking at a company's numbers.